Good morning, everyone, and thank you for joining me. It's the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address r@fxcm.com. Today is Wednesday. It's the 3rd of May. Thank you very much for joining. Apologies for yesterday. I actually pulled my back out, so I went to physio, and it's much better this morning. I'm just going to go ahead and bring up the disclaimers. We'll start off with the high-risk investment warning. I'll keep this on screen for a few moments. Can you guys see the screen? Can you hear me? And can you see me? Just want to double check. Okay, excellent. Thanks, guys. All right. We'll go just to the top of the hour, then we'll switch. We'll go move over to the crypto minute. But let's just discuss the interest rate environment. Want to show you market commentaries disclaimer before we do that. And just finally, the references, market scope, trading view. I've added a CME group here, so we're going to look at the FedWatch tool. Let's actually start off with the FedWatch tool. Today is going to be an interest rate decision by the Fed, and just be aware that it's going to introduce a whole lot of volatility. We're looking at 6 p.m. GMT, so that would be 7 p.m. UK, 8 p.m. ZA. So just bear in mind that there is a federal funds rate, and it's going to be most likely 25 basis points. And you can see in the Fed, in the FedWatch tool, CME FedWatch tool, that they're giving it an 86.7% chance that we move 25 basis points from a range of 475 to 500 to 500 to 525. That's pretty much baked in. So that's discounted in. What's going to be interesting is the press conference and the statement that comes out. Press conference is going to be at the bottom of the hour, so 8:30 p.m. ZA, 7:30 p.m. UK, and effectively what we want to hear is how hawkish the Fed's going to be. Now, if you take a look, this is the meeting for today, the 3rd of May. If you take a look at the meeting on the 14th of June, that's the next meeting. You just click on that, okay? It stays at 500 to 525. Go through to the 26th of July. Okay, it stays at 500 to 525. These probabilities are going to change depending on the data. Go through to September. Okay, it's actually come down to 475, 500. In other words, the market's pricing in a rate cut for the September meeting. So isn't it interesting? The market's suggesting that rates come down and that this is the last hike. Now, we've got to be very careful here because the Reserve Bank of Australia suggested that they were pausing last month, and then this week they've raised their rate again. But let's just take a look at the Australian core inflation compared to the US core inflation. Here's Australia core inflation, and I've put the rate of change. This is a rate of change. So we're looking at the 12-month rate of change over the quarterly. The change every quarter over a year-on-year basis, so 3 months over 12 months. And you can see, take a look at the rate of change. The rate of change here is still very high. It's above zero. In other words, we're still on the acceleration side. The core inflation isn't showing deceleration when it comes to Australia. Now, we just go through to the core PCE for the, and this is what the Fed watches, okay? Let's just take a look at this on an annual change. Okay, and we can see that there is a deceleration there. There is a deceleration on the US side. Just want to see if we can find the Australian. Let's just take a look. Australian core inflation. Let's just inflation. See if we can get it on a like-by-like basis. Let's try that trimmed. All right, we don't quite have it on like-for-like basis because this is 3 month over 12, not 1 over 12. All right, that's interesting. Let's just go back to the US, and the likelihood that this is the last rate hike in the cycle can certainly be made, okay, because on a 1 over 12, 1 month over 12 basis, it is showing signs of deceleration. And because it's showing signs of deceleration, it does suggest that the interest rates are starting to come through the transmission mechanism. If we take a look at US GDP year on year, okay, it is coming down. So the idea here is how much more interest hikes can be pumped into the economy without really causing some severe recessionary type of pressures. And the idea here is the market seems to be suggesting, we look according to the CME Fed Watch tool, that we've got until today to reach terminal, then it pauses, and then as we go into September, potential cut. That's going to be very interesting. Now, why would you cut interest rates? The reason that you would cut interest rates is because of recession. Okay, you'd want to stimulate the economy. So, what is the warning that we are near recession? Okay, I'm going to bring this chart. Okay, this is the yield curve, 10s minus 2s, and you can see that every time it dips below 0, we have what's called an inverted yield curve, and then these gray shaded areas are recessions. Okay, so we have a inversion, and then a few months later, so about 6 months later, we have a recession. Inversion, about 6 months later, inversion. A recession, I beg your pardon, an inversion, a few months later, recession, inversion. So in other words, we've got the inversion here. The question is, are we going to get the recession? The market seems to be suggesting we do get the recession because they're pricing in the rate cuts. So there's a clear division where the Fed sees that that they're going to carry on raising rates. The market seems to be pricing in some sort of recession. So with that in mind, let's take a look at our charts. Okay, if there is going to be some sort of recession suggested by the yield curve inversion, that to me would suggest that rates do have that pressure on the way down, and if they've got the pressure on the way down, I think that there's going to be a pressure on the dollar in the second half. And if there's a pressure, then this head and shoulders top still very much in play still. And let's just move this up here. And you can see that the RSI is on the bearish side of 50. If we just go through to the dollar over here, take a look what's happening to the dollar. It's moved from zone 1 back into zone 2. So there is a movement, a relative movement of weakness. But what's interesting here is the squeeze on the dollar. So what's going to be very interesting is in the press conference, what is going to be said about the recession? is a recession part of the forecast going forward? The last minutes, the minutes of the previous meeting suggested there is going to be a recession because of the banking crisis. Now, that banking crisis will effectively pass through to banks in that they will start tightening up credit conditions. So if they stop loaning money at an aggressive pace, that actually starts cooling the economy down. Well, that most likely has the cooling effect that the Fed wants without them needing to raise rates any higher than this today's hike. So today we definitely get 25 basis points. The question is this the last in the cycle? And I think a case can be made for it being the last in the cycle. Right, so there's a squeeze here, and we're getting the dollar starting to move down. If we go through to the hourly, you can see that we are in a very weak position, stochastic-wise. The longer we stay in the lower quintile, the more pressure on the dollar to the downside. Let's take a look at the converse of this. Let's take a look at the euro, okay? So the euro, oh, what's going on here? I'm jammed up. All right, let's use this. All right, let's go through to the euro. Okay, and let's just go through to the weekly. And here you've got a nice zigzag to the upside. Again, this makes sense. This makes sense so long as we are at the peak of the hiking cycle. Okay, take a look at this week's candle on the euro. Okay, it's a dragonfly doji. Now, there's still 3 days of trade ahead. There's going to be a huge movement today when the Fed comes out with their statement and press conference. I'm of the opinion, and this is subject to correction, that they come out more on the dovish side because of the fact that there is a potential recessionary scenario that seems to be building. Let's just go through to the daily chart here, and let's throw in some Bollinger Bands. Okay, bear with me. Okay, so I'm just going to build the zones here. So the first zone is going to be 20.75. Just take out the middle line. And then the second, take out the middle line. Let's make these red. And keep this at 20 and 2. And you can see that it's moving. So whilst the dollar was moving from zone 1 back into zone 2, look at the euro. Euro is moving from zone 2 back into zone 1. We seem to be in a very important point in terms of market news. Does the Fed give us that dovish bias? If it gives us that dovish bias, expect the dollar to come down, which it's showing movement from zone 1 to zone 2, potentially back into zone 3, euro moving into from zone 2 to zone 1. Right, let's just take a look at the DAX here. I'm going to carry on using TradingView just because my market scope's jammed up. Just go through to the DAX here. Okay, now let's throw in one extra. Oscillator here, indicator, and I'm going to put the Bollinger width. Take a look at this, guys. This is really interesting. And the Bollinger width is measuring the contraction on the Bollinger Bands. Okay, look how we're starting to squeeze on the DAX. Let's just put this in here. Okay, here's a squeeze. There's a squeeze. There's a squeeze. Okay, here's the squeeze. Here's the squeeze. Okay, here's the squeeze. Here's the squeeze. So we're getting to a point where it looks as if there's going to be an expansion. Okay, because that's what Bollinger theory says. It says when there's a squeeze, there's an expansion in volatility. When there's a squeeze, there's an expansion in volatility. Well, here's the squeeze. The question is, are we going to move to the upside? Or are we going to move to the downside? And what we can do here is we can throw in an RSI just to get some sort of momentum indication. And as long as it stays above 50, I would expect the expansion to the upside. If it drops below 50, we're getting the expansion to the downside. That would coincide, one would think, with a more hawkish type of rhetoric from the Fed. So there's a very clear nexus in the markets today. What is that? It's the Fed statement and the Fed, Jerome Powell's press conference. And if he comes out and suggests that there is recessionary pressures, if he suggests that perhaps there's going to be this is the last hike in the cycle, that they're going to adopt well, let's wait and see, then I think we could get an expansion to the upside. In other words, the higher yields have all been baked in, they've all been discounted in. Now the market starts preparing for some easing ahead, and we want to see if the squeeze in the Bollinger Bands has anything to say about that. All right, I'm going to stop here because we'll go on to the crypto minute in a moment. If there's any questions, please go ahead and type those in. Any questions, please go ahead and type those in. Oh, is there okay, just before you guys go, Chris is asking, is there a non-farm payroll link? Yes, there is. I'm sending it to everyone. So what we're going to do is we're going to be doing a live trade on Friday for the non-farm payroll. And I've just sent you guys a link. Just let me know if anyone hasn't got the link. If anyone hasn't got the link, just go ahead and let me know. Keep an eye on the jobs data. Is the jobs data starting to slow down? Okay, that's all right. I think everybody's got the link. If you don't, just send me an email. I'm happy to email it to you, and I'll give the link out in the next webinar as well, and tomorrow. Okay, guys, thanks very much for joining me this morning, and please join me for the next webinar on cryptos. Thanks.